Hello and welcome to today's RIMS webinar, sponsored by Evident, Uncovering Hidden Risks in Your Third-Party Risk Management Program. I am Justin Smolison, the host of RIMScast and the business content manager here at RIMS, the Risk and Insurance Management Society, and I'm happy to be your host. A few notes before we get started. If you have a question for the presenters, please submit them by writing in the question box. Feel free to ask at any point during the presentation. We will answer as many as we can during the Q&A portion at the end. And for those we cannot address, the Evident team will reply to you directly. Following this session, the recording will be available through the on-demand events page of rims.org. All downloads and contact information will be accessible to the sponsor. And on with today's presentation. Keeping up with third-party risk is consistently ranked as one of the most difficult aspects of a risk management program. And the stakes have never been higher, with 71% of organizations reporting that their third-party network contains more vendors than it did in 2021. Today's panel of experts will explore the challenges of third-party risk management, TPRM, and how you, our audience, can harness cutting-edge technologies that execute your TPRM program to meet organizational, regulatory, and industry requirements and best practices. RIMS and Evident are thrilled to welcome a large global audience. So let's get started by meeting our panelists. We will start with my friend, Manny Padilla. A lot of folks out there know him. Manny, please tell everyone a bit about your daily work, and if you want to start with your role at RIMS, that would be great.
Absolutely. So my name is Manny Padilla. I've been called worse. Usually respond best to Manny, but I'm on the board of directors of RIMS. I'm the vice president of risk management and insurance for a company called McAndrews and Forbes Incorporated. Been with them for 30 some odd years, and I'm happy to be involved in this presentation.
Thank you so much. And it's always a pleasure to see you live like we did last month in Risk World. Over to Tony Visconti, who I knew from the RIMS International Council. Tony, tell us a little bit about yourself and your work.
I am sorry, we're having some issues. Can you hear me now?
Very good. Yep, go right ahead.
Okay. Directionally challenged here. I'm the Director of Risk Management for Thales North America. We are a large global French company, 67,000 employees in 70 countries. And I have been part of the Risk International Council and a RIMS president for Oregon. And I've been 47 years as a risk professional.
Fabulous. Well, thank you so much for joining us, Tony. And we're finally meeting face-to-face, virtually, of course. And then another one of my favorite people is here, RIMS Board Director, John Klein. John, welcome. Tell us about yourself.
Thanks, Justin. Glad to be here. Like Justin said, like Manny, I'm on the RIMS Board of Directors. My daily role, I'm the Director of Risk and Insurance Management at Discover Financial Services, one of the leading direct banks in the country, as you probably know, from our credit card product. And I've been a risk professional for 20 plus years.
Terrific. And rounding out this talented roster is the CEO of Evident, David Thomas. David, welcome.
Thanks so much, Justin. As Justin said, my name's David Thomas. I'm the founder and CEO of Evident. I've been in the risk arena for about 20 years, and we built Evident to develop a SaaS platform for third-party risk management that revolutionizes the exchange of risk data and enables businesses to operate with confidence.
Outstanding. So we've got a lot to cover, and David is going to essentially be the moderator today. So David, are you ready?
Ready to roll.
All right, then take it away. The virtual floor is yours.
Well, that's great. Thanks so much, Justin, and welcome everybody to today's webinar on the importance of third-party risk management. We're thankful to have our panelists today who bring a wealth of experience from diverse industries. And in the session today, we're going to start with third-party risk management and how you prioritize different risks effectively. We'll touch on the role of insurance verification in TPRM programs, as well as the impact of technology and AI. And finally, we'll discuss the essential partnership between risk management and procurement in maintaining the balance between enforcing risk controls and nurturing vendor relationships. So thank you all for joining us. Now let's dive in to how we can all better manage third-party risk and protect our organizations from potential pitfalls. So with all that said, I'd like to start with a handful of questions for our panelists. And I'd like to begin, understanding the importance of TPRM programs, and particularly, many of you are considering TPRM programs. And I'd like to know from our panelists, what are some examples from your careers that really illustrate the importance of TPRM and will help others on this call today avoid underestimating it? And I'll just serve that up to the whole panel if anybody wants to volunteer to go first.
Well, David, let me jump in here a little quickly here. So first, I think we need to define or redefine what we're talking about. We're not, this is a conversation not about cyber, which is, has been called third-party risk management and the management of digital, vendors and things of that nature. But, the importance of third-party risk management can't be understated. I've been collecting and issuing certificates of insurance for 30 some odd years. I probably have 50,000 certificates of insurance from a variety of different vendors in different places. And again, the focus is those pieces of paper are effectively insurance policies that I would call on in the future in the event that one of our vendors products or services cause some injury, and basically an asset protection mechanism.
That's great, Andy. Thanks so much for defining it. And I'm so sorry you have 50,000 certificates of insurance. That's terrible to hear.
I'll have more. Yeah.
Yeah, David, I think, what really first struck home for me, and it's probably the supply chain challenges that a lot of our organizations have experienced during COVID. But, I'll just give you a personal example. I went out to buy a sofa. They didn't have any foam rubber. Well, to make the sofa with. Well, that was because of the deep freeze in Texas several years ago. And it's like, that deep freeze in Texas is impacting me in Chicago. So, as a consumer, I didn't buy a sofa, but as far as the furniture manufacturers, that is personally a good example of third-party risk management. You've got to understand your supply chain. You have to understand your pinch points, choke points, whatever you want to call them. But if you have a sole supplier, that's an exposure that you need to identify.
Yeah, Tony, would you like to add anything?
I would. I agree with both Manny and John that supplier risk management programs and the way we handle our procurement and supply chains is extremely important to the company. I don't know, I'm sure we've all had some losses as it pertains to third-party risk management. I have one not recently with this company, but one that sticks out because it was about a $700,000 loss. We had a contract that did not have the insurance contractual language in there. We also did not have a certificate of insurance that would go hand in hand with that. And we had a large issue and we were unable to collect from this supplier because of those reasons. We ended up out of that 700,000 getting about $163,000 credit for the next time we would order something, but that left over $600,000 on our books. And while people may not experience that size of a loss, or sometimes bigger, I think it's really important to our financial bottom line to look at all of the ways that we can mitigate the exposures that the supply chain brings to our companies.
Yeah, that's great. And I really appreciate everybody's perspective. We have a fairly unique perspective evident because we deal with so many different companies, and we've seen, basically every type of loss you can imagine. And, I'd say the common thread that I see in the industry is just kind of a casualness about administering these programs. There's a traditional way they've been done. People eyeball documents, people have a feel about a company. They kind of go with that. And the reality is these programs have to be very well thought out, and executed in a reliable fashion. And that's where we see companies fall down. And certainly the reason why many of those companies, come to work with us. But it's that casualness that I think is what's to be avoided. And so with that said, you get people on this line who are thinking, that maybe they haven't started a formal program, or maybe they've been, relatively, casual about it as well. Where should you get started with third-party risk management? Manny, Tony, y'all both run, really large risk for really large organizations, very diverse, conglomerate, like organizations. Maybe y'all could offer a perspective here.
Yeah, I'll jump in. So, in our organizations, the different subsidiaries have different requirements. And, some of them are, pretty black and white, individuals coming onto the facilities and ensuring that they have proper workers' comp. Because let's face it, I mean, if they were direct employees, you have, employer type of defense. But if they're not, they're contractors. And yes, they get injured and collect under their workers' comp policies, but then they come sue you separately. So from a really simplistic protection of assets perspective, getting a certificate of insurance and identifying the coverage, basically protects your own assets from those situations. But there are also other long-term exposures, which is they're providing products that are using your products, and their base product can cause significant injury to your company, and therefore put your business model at risk. It's not a complete solution, because your program should be designed to take care of that issue as well. But it does become a subrogation issue, and you definitely want to pawn off the risk. God forbid you also have one of these, asbestos types of situations where, in essence, you do have other insurance assets to call upon. It's not perfect. It's not direct, but, as being an additional insured as an example in a program design, both contractually and having some semblance of proof that there is other coverage does protect your assets. And again, balance sheet protection is really important. Otherwise, you have to take a reserve for that potential loss.
Yeah.
I'd like to add that I think it's difficult sometimes when you're a small to medium-sized company. As a large company, we have a pretty good handle on our suppliers. We have an entire procurement team on a global basis. But when you're a small to medium-sized customer, which I used to handle a lot when I was a broker, they don't know where to start sometimes on a risk management program. And so they're collecting certificates and looking at contracts, but they don't really know who their supplier base is. And I would suggest that if you don't know who your supplier base is, that your finance department and would be a great way to start, because they will have your accounts payable department will have all of the information on all of the suppliers that are typically paid out of accounting. Then you might want to ad hoc that with your real estate department or other groups that might go under the radar where it doesn't look like it's a supplier, but it is a supplier. So there's a bunch of different avenues that you can take to really delve into what suppliers you have, what the criticality of those suppliers you have, and how much you're actually paying them on an annual basis, which will then assist you in the legal department to make some decisions on how you want to go forward and handle your third-party risk management program.
Yeah, great point. I mean, you can find them because they eventually want to be paid, and so the finance department should know how to reach them. And the other thing that strikes me about particularly your organization, Tony, and yours, Manny, is that you're really setting a policy across a bunch of different organizations, wildly different organizations in some ways. And have you found that those elements of the program you just described? Have you found that you've been able to universally apply them to the different divisions that you work with, or do you end up having to customize the programs, on a division by division basis?
I'll take that one first. We're a global company. Our parent company is out of France. So, being a European centric company, they don't pay as much attention to the litigiousness that we have in Australia, the US, Canada, and a couple of other countries, the UK. And so, here in North America, which I'm over, I am very diligent, I will say, in the policies and procedures that I work with our procurement teams on, and our legal department. They're a backup for me, because they know the issues that our supply chain can cause. So we do a lot of training and education, but a lot of guidance goes to our teams on the right way to write a contract,
Yes.
the right things to put in that contract. I work very closely with legal on the customer contracts and the supplier contract. So I think it's just really important to know what suppliers you have and what issues they could cause for your company, and then work on those either holistically or individually.
You know, what I will add is that, you know, in basically just expanding on Tony's comments, you know, the legal team is very important. The procurement team is very important, and getting them to understand the why is extremely important. Because when people basically just sign contracts or just allow vendors on site without going through this process, that's where the open items are. But what is important is to also recognize that there are different types of vendors, and the different types of vendors each pose their own types of, you know, their own magnitude of exposure. So a security guard, you know, contract, a little different than, you know, the person that's delivering mail or, you know, just doing those types of issues. And so, you know, for me, the success is developing a template or at least a model of what is expected from a base level for all types of lines, and then expanding that to kind of centralize, for instance, if you're doing some cyber related issues or software development issues, your third parties have a different type of exposure than just slips and falls. So having that type of template in place so that everybody can refer to, and then having an acceptance type model. Because there are entities that you're going to deal with that don't buy 30, 40, $50 million worth of coverage. But in essence, if they're doing a low hazard type of a function for you, they really don't need it. And there are others that you better have it if you're going to protect your assets.
Yeah, that's great. And
Yeah,
John, any other thoughts? Oh yeah, please go ahead.
Yeah, I was going to say, let me jump in there. I mean, both Tony and Manny's organizations are much more diversified than being a bank, but it's not only the you know, the different corporations that they own. We're a growing company. You have an entrepreneurial flair. So you have the lines of business that they're running their own P&L, but they're much, you know, they're part of a much larger organization. You got to keep your eye out on those people too. So it may not be a diverse company, but you got to really have those relationships within the lines of business, and, you know, make sure they understand the risk. I mean, we're all part of the same bank, but if they're trying to grow a product, they're going to do what they need to do to grow that product. So I'd also caution the people that don't work for large diversified companies that are a little bit more focused. You got to drill down to your lines of business, your SBUs, whatever your term of art is, and make sure they understand it too.
Yeah, no, that's great feedback, and I'd like to kind of piggyback on that a bit. So once you've identified all of the, you know, kind of categories of third parties that you've got out there, and you've kind of enumerated the business units, you know, the way you described, John, what are the most common types of risks that are overlooked in these programs? You know, and Manny, you said it right off the top. This is not all about cyber, right? This is broader third-party risk management. So I'd love to know, you know, from your perspective, what are the most common types of risks that are overlooked? And I'll actually start by seeding one, which I believe, Tony, you mentioned first, which is that, you know, we're collecting COIs, but, you know, if you don't have your contract right, if you don't have the language in your contract right, that could be useless to you. And so maybe if you could elaborate, or the panel could elaborate a little bit on that point, and then cover any other risks that you feel like are overlooked, that'd be great for the audience.
Thank you. Wait, my camera's not working here. So yes, I work
We
very
can see you fine.
closely.
Everything looks good. Yeah.
I work very closely with legal. We go hand in hand together. And I think that if you don't have the contract right, a lot of times that will negate any certificate of insurance that you can get. We'll just take a little simple section of a contract called the limitation of liability. That has a could have a direct adverse effect on a supplier's agreement. And I'm going to use one of the ones that Manny brought up: security companies, fire, watchmen. They have usually a very tight clause in their contracts that say, we're only going to pay you under the limitation liability the amount that you've paid us for the last 12 months in services. That could be $50,000. That could be $200,000. However, we could be asking for $1 million or $2 million. And all of a sudden, that's just gone right back to the 250 or whatever that service fee is. So you have to align those contracts and the insurance by maybe carving things out of the limitation of liability or expanding it. And those are hard conversations that you will need to have with some of your, especially smaller suppliers or one in a niche like a security type company. So I think those are really important to look at. I think overall, with regard to what gets not thought of as much is facilities. I can't even tell you the amount of uh, contracts that we have for facilities personnel and people to come in and do all kinds of things from construction to delivering food and everything in between. And sometimes we think of them as very benign exposures, but they could be very large exposures depending on what they're doing for us, like burning our building down or running a vehicle into our building. So it's really important that we look at those contracts that we may not think are important, but really are and can have an adverse effect on the company.
Yeah. For me, it's the secret of engaging legal and procurement and setting the tone as to what's important and what's not important. But at the same point in time, cutting corners is where you find where your facility burns down because your security guard, although he responds, doesn't know how to turn that off the sprinkler system. And instead of it being a fire damage issue, it becomes a water damage issue. You know, so those types of events and interactions are, you know, can cause some real concern. But again, for me, it's always been about the training, having the contract come through you to work through the indemnity agreements, the limitations of liabilities, and the exceptions to those limitations of liabilities. Because as Tony mentioned, you don't want one to negate the other. But at the same point in time, you know, having that additional insured status or having the wording on the certificate and the agreements, in some cases, kind of reverses the reverse. So it's kind of like playing Uno. And you find that you do have, you know, risk transfer, which is ultimately what we're trying to do here. We're trying to prove the risk transfer mechanism.
Yeah, and you know, if you're looking for unhidden or hidden risk, I think one of the things in today's world we all should be aware of is a compliance risk. And I mean, I operate in a very heavily regulated industry, and I mean, both Manny and Tony's companies, they operate in regulated industries. You know, not only do we have to be compliant, but we also have to understand our third parties compliant, because there we have a vicarious liability. And, you know, the contracts, they can all be buttoned down and everything. But at the end of the day, we have to make sure we understand their, you know, what their shop is like. And, you know, I think if you start going down the chain, there's not only third-party risk management, but it's fourth-party risk management too. Because just like we're outsourcing functions, the third party is outsourcing functions. So I think those are some of the hidden things as we go on this journey is, you know, especially compliance. You know, we work real hard to make sure we're compliant, but are our third parties compliant, especially if they have customer focused, customer facing products, or if there's a product liability. But then what are their vendors doing from fourth party perspective too? So I think those are two evolving ones, David, that, you know, going back to your question, what should we be looking at? I think those are some new and evolving issues that people ought to be thinking about.
Yeah, thanks, John. And just out of interest, and we'll see if I can make this question make sense, but you know, do you consider your third party's compliance to ultimately roll up to your compliance? Like, in order for you to be compliant, do those third parties have to be compliant, or is that just an indicator of risk as you see it for the third parties and even the fourth parties?
I would tell you our regulators, they need to be compliant. So yes, that does roll up to us.
That's right. It does roll up. Yeah.
Absolutely.
Very interesting. Yeah, you know, I think from our perspective, you know, across all the different types of companies that we see, getting the documentation in place is really essential. You know, I think that you guys have talked about some great enforcement mechanisms with finance, and those are excellent. We see about 31% of third parties that just never respond to requests for documentation after the contract is signed. They're happy, they've signed the contract, they're going to get the business, they're off, executing, and they're not finishing the onboarding process. Which of course, puts them in exactly that situation you guys have described, right? Where, it's time to transfer risk, and you're just in a terrible position to do that because you don't have everything on hand that is that's needed. So let's see, we've covered a couple here. We talked a little bit about regulations and compliance there, and what John just covered. I wonder, Manny and Tony, do regulations play a big role in your programs today, or is that kind of off to the side?
Well, I'll jump in on that one, Tony, if you don't mind. So, yeah, regulations play in significant ways because, quite frankly, the deep pocket is the person that gets pointed to and gets looked at by the various your regulatory bodies. But we do have customers as well. And while our customers are depending and requiring of us to perform certain functions, and quite frankly, they don't care that our vendors or our subcontractors have caused the loss. That's kind of my problem because they're coming against me. So yes, regulations do come into play. And even if it's just a social type of event, which is we have a responsibility when we're the big cat in the transaction to do the right thing. And nobody really cares that it's somebody else's problem. If you're the front person, you're the front person.
Got it.
I completely agree with Manny. We're the backstop to our customers, and they really, in some cases, don't care who we hire. They just expect us to hire the right people to do the job. And if they're not doing the job, they're not going to go back against that party. They're going to come back against us.
Yeah, that's great.
Yeah. So let me kind of close it out because I'm kind of on the other extreme. Back in June of 2023, interagency guidelines came out to all banks, and interagency being the FDIC, the Federal Reserve, and the control of the currency. And they came out with third-party risk management guidelines. Mm-hmm. So as a financial institution, there are certain things that we are required by regulation to do. So I think I agree with everything Manny and Tony said. I'm going to translate it differently. The plaintiff's bar is the ultimate regulator, but we've got federal regulators that are, making sure we look at everything through the entire life cycle of that relationship.
Yeah, well, that's the perfect lead into the next, area I want to go to. Is where does a third-party risk management program start? Is it, diligence ahead of, the contract being signed? Is it, some type of filtering that happens even, before candidates are considered for contracting? What is that? When does that life cycle start? And then what does that life cycle look like in your companies?
I'll jump in on that. The life cycle starts the moment you're starting to do business, because you could be out of the business in the first transaction. So I think it's in having a stable and recognized, program, basically having an enterprise risk management approach to protecting the assets of the company. And then one of them is the contract, because you're selling or buying a service, and ensuring that, your terms and conditions are, addressed in your contracts. 99% of contracts have indemnity provisions. Some of them are mutually hold harmless. So you're giving the same type of indemnity to a third party. It's just how do you finance that? And then that's what you're trying to do. You're trying to find a contractual financing mechanism, but you also want a third party AAA rated insurance company to protect your assets there. Mm-hmm. So it starts there. I don't think it ever ends. I think it gets better as you evolve and as you find and have those near misses, and then you continue to refine it. And then you also refine it because when people move out of procurement or people move out of legal, there's a training mechanism that has to be there. So it has to be an ingrained mechanism or in the culture of the organization.
Got it. And does that extend to screening them prior to selecting the vendor or the supplier that's going to get that business? Is it diligence on the very front end of that process? Do you guys include that in your programs?
Absolutely. I was just going to follow up with Manny to say that I agree. It should start as part of your business process. It isn't a separate part of your business process. So if you're going to manage onboarding employees, you have to think of it that way. You're onboarding your suppliers. So you need to have a program ahead of time and not after the fact. So you have all the things that you do in place to onboard a supplier to make sure that they're going to be there long term for you. I mean, obviously, you don't need to onboard Jimmy John's pizza or sandwiches, but you do need to onboard those suppliers that are going to be a consistent part of your business. And then there's always going to be instances, and we have them all the time, where we have a particular contract that we need a particular supplier on, and maybe the customer might even want us to use that supplier. They're not part of our system. And then there's an ad hoc, oh, now we need to do it after the fact. But those are going to happen. But you need to have the process so that at any point when you have to onboard somebody, whether it's at the very beginning of a relationship or in the middle of a contract when you need somebody, that you have that process in place.
So David, we kind of break it down to some very discrete parts. I mean, the first is a third-party selection. You go out and you evaluate who you want. You do your due diligence. You maybe run an RFP. Then you have an onboarding process. That's when you do your risk assessment. Then you have a formal contracting process. And again, all these are sequential. And that's when you're actually negotiating the contract. And then once it gets in place, you're going to have your ongoing monitoring. So that's where you make sure the SLAs are hit, if you have KRIs, KPIs, and then you have ongoing governance of that relationship. So, I mean, again, the regulators helped us articulate this, but I think this is exactly what Tony and Manny are saying. But if you put it into those big buckets, you know, third-party selection, onboarding, contracting, monitoring, and governance, those are probably the heart of a really good TPRM process.
That's great.
Let me jump in here because I think it's important to also recognize that I don't believe the risk management group is the best group to kind of quantify the success that a particular vendor is going to have based on the group of vendors, et cetera. But one of the control mechanisms we do have is reviewing the insurance, provided or the capability of the vendor to provide evidence of insurance and looking through that certificate of insurance. If you see that they're doing business with this Kabibble insurance company, you know that there's a problem there. And when you start getting complaints on, well, I can't buy $5 million worth of limited liability insurance, then you have to start to wonder, if you're running a security guard concern. So those types of things add to the whole decision-making issue. And some of the biggest issues or problems that we have are, well, can we give them a break? I said, okay, yeah, they're delivering paper, the workers' comp is key. And okay, wonderful. Again, if they're managing my power plant, no, that's not acceptable.
Right. Yeah, and you went exactly where I was about to go. So, I mean, all of you from the very top of this, program, you all have talked about insurance as being, verifying insurance and COIs as being critical, to a third party risk management program. And I mean, I know we're all in risk management, and so that it seems obvious, but is insurance just the ultimate backstop? Is that why it's such a critical part of a TPRM? Or Manny, you just kind of talked about an angle there that is really interesting, is just evaluating whether or not they've purchased insurance or what carrier they work with. It can provide signals about the quality of that company that you're considering. But yeah, why is verifying insurance such a critical part of a TPRM?
Well, other than the certificate of insurance, all you have are the agreements and the contract that they will indemnify. And that's great. I mean, there are companies that, multi-trillion-dollar companies that will indemnify, and you kind of give them a pass if they get a AAA rating, because you expect that they're going to honor their agreements, especially if they're in the marketplace. But again, risk managers don't know each of these vendors individually. And there are things that may happen at these companies. And, a perfect example is the company goes bankrupt. That's okay. That's a bad thing, maybe. However, you still have a call on that insurance program, which is the only asset that you have to chase. So while insurance isn't everything, again, what you're doing is you're trying to protect your balance sheet, because if they default, or that risk transfer mechanism doesn't come into play, that's your problem. And then you have deductibles and you have your own loss experience, et cetera. So I think it's a nice financial tool to be able to, execute or to achieve your goals. But it's not the only, solution.
Yeah. John, Tony, anything to add to that?
Yeah, I really look at insurance as the ultimate backstop too. Pick any sport you want. If you're the goalie in soccer or hockey, everybody else can fall down, but if the ball goes into the net, it's your fault. We are the ultimate backstop. If somebody's looking for money, we want to be able to provide it. And to Manny's point, that's when you need to have the evidence of insurance.
Yeah, Tony, I saw you nodding to that as well.
Yes, definitely. I have a couple mantras that I tell our procurement teams, especially when they ask me about, the indemnity clauses, and, oh, we have a indemnity clause. They've signed the contract, and I'm like, it's a very small supplier, and their indemnity, the indemnity provision is only as strong as the company's financial strength signing the contract. So if they can't withstand a $5 million claim, and that seems to be the exposure, then all bets are off, and you have to have a backstop, which is insurance. We also have, as companies, some of us have very large deductibles, and so we're put in a financial bind, not actually a bind, but precariously positioned if we have to use those large deductibles to backstop our suppliers. So it behooves us to make sure that our suppliers are financially stable and that they have the backup in insurance to backstop anything that could happen vis-a-vis their financial status.
Yeah. David, can I add an issue here? Because I know we've been
Yeah,
focused contract and the schedule of insurance or certificate of insurance, et cetera. We have some vendor agreements where if they're performing work for physical work on our facilities, that they go through a safety program type of approach. And then that safety program is looked at by my safety professionals. So in the procurement process, the contract is just one piece of the puzzle. The safety review is another control mechanism to ensure that, if anyone does get injured, that it's, we don't get blamed because, we failed to train them. We ultimately do have a safety program, protection type of exposure as well. But this is just one mechanism of getting it through. So it's not a simple, you agree on the contract, provide a certificate of insurance and shut up. No, there's a little bit more complexity here. These are just some of the control mechanisms we use to achieve our goals.
Exactly. And you've got to get through all those gates before you're allowed to do the work. It's not as though you've signed the contract and you're off, to the races doing the work, and you follow up with insurance or you follow up with the safety checks. These are prerequisites to doing the work.
Right.
Yeah, that's excellent. Well, what role do you guys see technology playing in the third-party risk management space?
You want to take that first, John?
Sure. So I think like everybody else, we have thousands upon thousands of contracts, and we have to build in KRIs, KPIs that can go out there and monitor those contracts. There's no way one person can do it. Also the way, one of the key ways we provide technology, we have just used it to much more streamline the process flow of the whole contracting process. It provides more consistency. It provides better protection for us, and overall it helps drive better pricing. So, there's no AI, generative AI involved in here. It's just constant process improvement and really technology, digital ambition, if you will. That's really a real good example is we're able to do more work with the same number of people, and the company's actually better protected, and all that's going into risk registers automatically. So, it's saving headcount, it's getting people out of, rote work and helping people develop better into more, thoughtful types of jobs.
Well,
And
I've been working on this issue for far too long. I recall when we would get the PDFs and basically they were all wrong. So we'd go back 2, 3, 4 times to get the corrections because everyone conveniently forgot to add the additional insured status and the waiver subrogation issues, and, notwithstanding the mistakes in the names. So, but the history of the issue is, compiling that information is, it's a key record for the organization. And if it gets stuck with the contract, that's great. But even some contracts get destroyed after so many years. But the coverage under the insurance program or access to that program lasts forever. So for us, it always became an asset. And managing that asset was everything from making copies to eventually digital media came into play, and it started off with PNG files, then became PDF files. And now you're able to extract that data through some, artificial intelligence mechanism to at least create a worksheet to know where that information is. But it's continuing to evolve, and it needs to evolve. One of the biggest issues are, does it comply with your base requirements? Because you're getting thousands of these things a year, and it's, you need a full-time person just to manage that.
Absolutely. Yeah, Tony, would you like to add anything?
Well, I think that automating all of the processes having to do with procurement and third-party risk management is critical from the very start with the vetting and onboarding of the customer or of the suppliers, so that we make sure we have all the documents that we need from them and that we have all the background checks that we've done. We're in defense and security as well as all the other things we're in. And so it's really important for us that everybody has the right clearances that they need to have to even be allowed on some of our sites. Then you go to the scalability, the enormity of a large, even a medium company, and all the suppliers that you have. One person can't do it. 2 people can't do it. So you have to have the automated technology to be able to sort through all of that data and compile it and then give it back in a report that you could use for compliance and regulatory reasons, for audits that may happen. So I think it's really important that technology is playing a big role in our roles and that of our procurement departments.
Yeah, really well put, all of you. I mean, certainly being a technology company, we see technology as key to solving the problem. But John, I really appreciate what you said. It's certainly not that, generative AI to the rescue, for risk management solves every, TPRM problem. However, there are some great point cases where you can use more modern technologies like AI to really improve the results of individual evaluations that you need to do in this space, and kind of get past the eyeballing it that a lot of companies are doing today. And the risks are so intricate and the coverages required are so intricate, it really becomes hard even for a well-trained person or a well-trained team of people to actually honestly and accurately evaluate every document coming through, especially as the requirements, change from supplier to supplier. And so that's where we've really seen the benefit of applying, technology, is to get much more reliable and thorough results, even with extra large and extra diverse populations of third parties. And certainly AI has a role to play in that. But John, I commend you for being the only person on any panel recently who has said AI has a limited role. Thank you very much and I agree wholeheartedly. We've talked a bit about this already, but I'll cover this and then we'll open the floor for questions. You guys have all talked about the importance of partnering with internal organizations, especially, procurement. Can you just talk with the audience a bit more about that? Why is that? What does that partnership, look like? Why is it so critical, to executing a TPRM program consistently?
Well, I'll
So
jump
let
in.
me, okay.
Go ahead, John.
So mine's real easy. I roll up to the chief procurement office. So you know, it's something I live and breathe every day. Now, you know, I've got my silo, but I mean, it does provide me a platform, if you will, to talk about everything that we've talked about here today. And we actually have a separate third-party risk management team, which is in the chief risk officer's world. That, you know, that's another key business partner. So, you know, I think internally for us, in what my day-to-day world is, it's the procurement and sourcing area that I'm part of, but also the TPRM team that is part of the risk officer world. So and I think the other party is we don't own the risk. Nobody on this call owns the risk. We have to make sure our business partner, internal business partner, understands that they own the risk. So I think that's the other collaborative nature, David, is that when we are doing a deal, the person that's responsible for it can't just throw it over the fence.
Right.
They have to be held accountable for it and take the responsibility for whatever it is, the project or whatever. And if it doesn't meet the standards, they have to risk accept it.
And John, those are great comments because it's an enterprise risk management type of approach. And you're right. It's if someone doesn't think it's their problem, they basically say, well, it's risk management's problem. But it's not. It's everybody's problem. And one of the things that we do a lot of work on are speaking with procurement, speaking with the contractual persons, speaking with the person that's making that phone call, trying to get that vendor to come in to do elemental P, repair a pipe, etc. Says, I need to do it now. Says, yeah, but it's not immediate. Let's look at contracts. Let's ensure that we're dotted the I's and crossed the T's. Because yes, when he falls off the building, that's your problem, not their problem. And so keeping those things in focus, gets people, and I hate to use the word, but it is conditioned to, thinking strategically. And that's thinking strategically, starts to permeate throughout the organization. It becomes part of the culture. And before that next call goes out, the first question is, does this vendor already have a certificate of insurance or their safety protocols in place prior to them arriving to our facility? So, and what I've seen on the procurement side is, some of the more advanced, operators get their 5, 6, 10 different, service providers, and they get them to provide the information on an annual basis before they get called. And it actually makes the process a lot easier.
No. That's great, guys. We've got a bunch of questions that are coming in, so I'd like to move on to questions from the audience, if that's okay. Well, perfect. All right. So question 1, when it comes to reviewing, verifying contractor insurance, what, if any, steps are you taking to ensure there aren't unexpected or concerning exclusions on the vendor's coverage? I certainly have a perspective on that in terms of what needs to be done, but I'll turn it over to the other panelists if anyone wants to volunteer.
Yeah, I'll jump in. Sometimes you have no clue. I mean, your contract requires that you have certain types of insurance, and in some of the in the templates within the contract, it talks about having contractual coverage. It talks about having concurrent coverage, the primary and non-contributing type coverage. But you're right, you don't have the physical policy. But if you do have a critical exposure, for instance, the other side is building nuclear power plants for you, maybe that's the type of conversation that you want to see, the policy. And I know the extent that we did that type of issues, that we had a contractor and they basically required an outside agent to come in and perform a cleanup function at a chemical processing business. And it was like, okay, but I think that's one where we have a real conversation with the other side.
Absolutely. Yeah. Tony, John, anything to add there?
Yeah, I mean, I would agree with Manny. I mean, the last thing I want to do is look at a bunch of insurance policies that aren't mine. And, then we become a consultant to a third party, which I don't want to do that either. At some point, there's a certain amount of faith we have to have.
Mhm.
And unfortunately, that is hidden, but then it goes back to the contractual language.
Yeah, that's great. And Tony, you were saying something?
I have looked at policies. I don't do it very often, don't want to do it at all. But if I have a critical customer and I have some very specific requirements that are being flowed down to Talus, I will ask, and I'm unclear on a critical coverage from a supplier, I will ask for more detail or to have a conversation live, virtually with them, to go through their policy, and look at any exclusions. And I will tell you that most suppliers don't even know how to read a policy. So,
Right.
um, so there's that.
Right.
But
But
anyway,
you may
yeah,
be
so
telling them
we
they
do
have
that on,
exclusions.
we do that on rare occasions and where a
Mm-hmm.
disconnect could have a huge ramification to the company.
That's great. Oh, that's great input. Question 2, any recommendations on certificate tracking providers for assisting with third-party compliance tracking? I will volunteer that one. My company is Evident, and we do exactly that for hundreds and hundreds of enterprises that are evaluating hundreds of thousands of businesses every year. And so Evident would love to help you with that. If you think about the space that we're in, we're very software first, very configurable in the system, meaning you can program highly customized requirements around more than 50 different lines of insurance coverage. And so for whoever asked that question, we would certainly love to help you. Let's see. Question 3 for John. What types of KRI or KRIs is your bank using to monitor vendor contracts?
So a lot of it varies by contract, quite honestly. So, it depends on the criticality of it. A lot of it, I mentioned the importance of compliance for us, whether or not they're complying with laws, and also uptime versus downtime. I mean, if we are depending on them to provide us certain services so that we can provide those to our customers, we kind of have a mantra of 5 nines. We want to be up and running 99.999% of the time. So, those are the types of SLAs, KRIs that we're going to have. We also talked about the financial wherewithal of the companies. What's their credit rating? Do they have any known issues? So, I think those are at a very high level, some of the ones we get into.
That's great. I apologize. I've disappeared. My Zoom client bounced, but I'm back in, and I am sure that was a fantastic answer, John.
You're doing
Question
fine
number
there, David. Keep it going.
Yeah, question number 4 is for Tony. Tony touched on the size of a department. What insights can you have setting up a risk management team in-house?
Well, I'm a department of 2. And in North America, we have, I think it's the smallest company that I've worked for from a geographical standpoint. We have about 7,000 employees in 27 states and 2 countries. And so we are looking forward to things such as what Evident can provide and other services to ad hoc our department. We have some RIMS systems that we use. So I think that you have to take a hard look of what is the risk management department tasked to do. I pretty much do everything. So I'm looking at contracts, I'm reviewing suppliers with the procurement department, I'm training, doing a lot of training and education with legal and procurement and a lot of other our internal stakeholders. That takes a big part of my time. We have workers' compensation claims that we manage. We manage auto claims. So we're doing a lot of different things. So it's what does your company need you to do? What can you outsource to, say, your broker if you're a smaller company? What can they do for you? What can you do for yourselves? And I would say we're about a $3 billion company in the United States. Worldwide, we're about 18 billion. So for us, it usually goes by revenue. I would say one to two people for up to 5 billion in revenue, and then you grow after that. It just depends on what your company stance is on how big they want their risk management department to be and how much money that they actually want to put into the infrastructure.
Got it. Very good. I think we've got time for one more question at this point, and it's a good one. Do you have any advice when risk and contracts are on the same page regarding risk transfer, but the internal customer or colleague views compliance as a barrier and pushes back on the insurance requirements? I'm sure none of you have run into that situation before.
I'll jump in on that one. So it's really an issue of allocation. It's wonderful that they're playing with the corporation's balance sheet, the corporation's profitability, just to make a transaction. And not to be flippant, but a lot of the conversations that we get into are, I like this company or I like that company. But there are control mechanisms that you can put in place as well, which is not to do the job for them, but to assist them in being able to procure those types of limits of insurance. And the reality is, if it's a key critical vendor, then the loss follows the exposure. If you need more coverage, you point them in the right direction, you get more limit. And there are methodologies where you could buy one extra limit for one particular customer. And if it's really bad, or from a business perspective, maybe you should consider protecting your balance sheet by paying for that coverage, not necessarily on their behalf, but crediting it in the transaction.
Got it. Yeah, interesting. Yeah, Tony, John, anything to add there?
We've done that as well. Sometimes we'll get a smaller critical supplier that just doesn't have the, say, professional liability coverage that we would require normally. And in the United States, there's a couple avenues where you can just send them to like Hiscox is an example, or another insurance carrier that they can go online, fill in all the information. They do it. And we offer to pay for it up to a certain amount, depending on the criticality. We do not do that very often, but this isn't a hard line. We can't have a hard line in risk management. Management can have a hard line. We have parameters that we need to work in. And ultimately, it's not our job to say no, although we'd like to, but our job to say is, if you do this, here's the financial ramifications to your entity or to the company. Do you really want to make that decision? And I say that every single day in a lot of different ways. And would I like to say no? I would certainly like to say no, but we need to be collaborative, and our job is to help our businesses make money. So we do what we need to do within the parameters that we have.
Yeah, I agree entirely with Manny and pardon me, Tony. And again, if there's an impasse, I'm going to go back to what I said earlier. The line of business is willing, if they're willing to accept the risk, that's fine. But as Tony said, part of our job is to help our companies do business. And if the decision is to accept a risk that can't be transferred, the line of business or your business unit needs to take that responsibility and be held accountable.
That's great. That's awesome. Well, listen, guys, we've had a great session today. I can't thank our panelists enough for their time and expertise. And with that, I'll hand it back to Justin at RIMS.
All right. Thank you, David. Special thanks to John Klein, Tony Visconti, Manny Padilla, and of course to David Thomas for their time and expertise. And thank you, the audience. We appreciate you logging in. The Evident team has your questions and will reply to you directly if we didn't address yours today. A copy of this webinar will be archived on rims.org within a few business days. There are lots of resources for you to access from Evident. You can find them at evidentid.com. You can also find Evident through their LinkedIn page. More RIMS webinars are coming up on June 13th and 20th, so register at rims.org/webinars. And finally, folks, RIMS is global. We'd love for you to build your network with us. Visit rims.org/membership to apply for a RIMS membership. This was a fantastic session. Thank you all, and stay safe.